Hi guys, today we're going to go through exercise 7.6, which you'll see the question up on the top left-hand side of our screen. And you can see it on workbook page 125 and I think you'll find it on page 147 of the textbook. So you should have both open, but the question is a short one and you can see all of it on your top left-hand side. What are you guys being asked to do? You guys are being asked to work out an inventory loss or gain, and there's a little bit of information that's been provided. What's that information for? It's for Preston Paints, and this information relates to the 31st of December, and it is for 2023. As you know from the textbook, 2023 is just a number, so the textbook will be relevant for the next 5 years for the study of design. You've been given, beg your pardon, a little bit of information. You've been given the total sales for the period, which is 142,000. You've been given the GST on those sales, which you know is 10% of sales. 10% of 142,000 is 14,200. And then the more important part of this question, in fact, the only relevant part of this information, you've been given two bits of information about how much inventory they think is available on the 31st of December of 2023. You've been told that the balance of the inventory account, so the general ledger, is 27,600. He's also been told that there's been a physical stock take. And there was discovered less when there was a physical stock take of 26,700. So you've got a lot of information there and you've got to work out what to do with it. The first question that you're asked to do is to prepare a journal entry to adjust the inventory account for any loss or gain. So you've got to think which part of this information is relevant to this question. In reality, the only bits of information that are relevant are the bottom two. So you can essentially cross out the top two. Yes, they've made sales, that's great. But you know that at the end of the year, they think in their ledger account, they have 27,600. But when they've done the count, they've got 26,700. So you've got a question to ask. Which one is more accurate? Should we believe the physical stock take or should we believe what is in our general ledger? And hopefully from all your understanding and reading of the principles of inventory, you know that the more accurate number is when we count it. So this is the accurate number of inventory, and we've now got to work out, is that an inventory loss or an inventory gain? Because there is a difference between the numbers. So let's think this through. We think in our records, in our ledger, we have 27,600 of inventory, but the stock take has 26,700. So the count has revealed that we have lost some inventory. How much have we lost? We have lost the difference between those two. 27,600 minus 26,700 using your calculator equals 900. So we have an inventory loss of $900. So we've got to record that in our general journal. Let's think this through. Sometimes it's easier to think about which one is the more obvious one. Do we have more or less inventory because of this inventory loss? Hopefully you understand that we have less inventory. And hopefully you understand that inventory is an asset. So now we apply our principles of PAYLA, debits and credits, and we understand that inventory going down, when an asset goes down, is a credit. So we know that our inventory has gone down by $900. We know that we have a debit because our debits must equal our credits. And we know that that is what, when we have an inventory loss, the account that we debit is called an inventory loss. What type of account is that? That is an expense, and inventory is an asset. And if we think through Paler, we know, or just our debits and credits table, we know that expenses going up, because expenses only ever go up when we're recording them, is a debit. So we've correctly identified we've got less inventory on hand, and that is an inventory loss that results in a credit in our inventory and a debit in our inventory loss. Now, if this was a 3-mark question and there's no reference in the question that says narrations are not required, we must do it narration. And that could be something, and remember, a narration is telling the story, something along these lines. We are doing a adjusting entry to record inventory loss. Due to, and we might want to include that it was due to stock take. So we don't know why the losses occurred, but we know there is an inventory loss due to stock take. And we would, very importantly, but it's not being given here, put a source document there. Let's say that would be a memo. So if we've done that correctly, we can absolutely tick off the first question. We've identified that there has been an inventory loss and we've recorded our debits and credits. Now we need to post the entry from part A. So pick up our general journal entry and put this in our inventory account and balance the account. So there's 2 components to that. Again, we want to almost think of this information here to be white noise. We don't need to record the sales or GST on sales in our inventory. It's not asking us to do this. Sales haven't impacted our inventory account here, or they're not telling us to. What we do know is that we have a transaction here that's asking us to do a credit to our inventory. When we are doing a credit, what does a credit equal? We know that when we're doing our general ledger, credit equals right side. So we're going to pick up that $900. Say that we did this on the 1st of December and record our credit. Now the hard part is our cross-reference. Our cross-reference is always the other side of that transaction. What was the credit in this transaction? It was inventory loss. Now we're asked to balance this account. We have a bit more information that we do need to put in here, because we know that the balance of the inventory account is $27,600. Balance of inventory is an asset. Assets balance are debits because that is where the positive occurs. So we should have actually $27,600 of inventory, 31 December, and our cross-reference here is balance because we don't have enough information to include anything else. We're now asked to balance it. What do we do when we balance it? There is a number of steps. We look at both sides and identify the side that has the biggest number, naturally the 27,600, and we include that in both sides. We then identify the balance, so the difference, which is 26,700 here, and begin our process of balancing. We have done a credit because we have recorded a cross-reference there. We can't just do a credit without a debit, so we are going to bring this down to the next day, the first day of the next month, and say that the balance beginning 1st of January is $26,700. We've balanced the account with all the valuable information that we've been provided, and importantly, once we stop there, we look at it, it makes sense. We've recorded here a $900 inventory loss, which makes sense from our information. And then we've recorded that our balance to start the next year is $26,700. And from our information, we know that that's the correct information from our stock take. So that would be how we would identify an inventory loss. The gain would be very similar, but we would identify inventory increasing, a debit, and inventory gain being a credit. And we've recorded this in our general ledger and balanced the account. Hope this has helped the process of inventory loss and gain. It's been a good opportunity for me to play with the pen and the tablet, so we will get cleaner with recording our exercises as I get better using this, and we will run through some exercises like this in class.